Hello everyone, a very good morning, good afternoon and good evening to all. Myself Vaibhav. In today's session of automated trading, we are continuing to work with the EMA envelope and the Williams R. This is the second part of the series which we started on the Friday. I hope you are well familiar by now with the functionality of the EMA envelopes and the Williams R also. We had gone through its details on Friday, and the min-max pretty simple, the ATR, and here is the standard disclaimer. And again and again I would like to remind you that this is simply a tutorial session to help you build an efficient algorithm, and of course no claim is being made regarding the profitability or otherwise of the algorithms shown during the session. And suppose if you want to use any of the algorithms, I would suggest that you do extensive trial runs and also allow it to run on the demo account for sufficient enough time to get the idea of efficacy of the algorithms. And of course, nothing in the webinar is to be constructed as an advice to trade or for particular setup. With that, we get started for our day. The setup is fairly simple, but of course a bit difficult to execute on the our algorithm platform. We have to bring in a lot of technical details to make sure that the algorithm works as per our requirement. Here is the brief synopsis of what we are trying to achieve. We want the trading to happen only after the EMA envelope has changed its course. So we will checking the value, the current values of the high band and the low band to the values a day back, that is using shift 6 on the 4 hourly time frame. And if the values are falling, we look for a sell trade. If the values are rising, we look for a buy trade. But as you can see that in a situation where the envelope keeps rising and rising, we want the trading to happen only during the initial time when it changes the course from being bearish to bullish. Then this buy trade should happen when it changes course from being bullish to bearish. The sell trade should happen only during the initial time. So to make sure that is the case, we are bringing in the Williams R, and here we will want certain values, certain conditions. If we are looking for a buy trade, then we will want that Williams R has been in a oversold territory for a considerable amount of time, and only after that this fresh trend is happening. And similarly for a sell trade, we will need the EMA envelope to have been in a overbought territory, and only after that this new fresh reversal is happening. And to make sure, we are bringing in here also current EMA values. We will be comparing to the values a day back using the shift 6 of the Williams R. And now we need to do further optimization as well. So what we are doing, we are bringing in the half an hour condition of the min max, and we are bringing in let me add the necessary indicators. So we will need the minima of 24 that will give us the value, lowest value of last 12 hours low price. And with that we also want maxima, and here we will edit it to make 24, and the time period should be of 30 minutes. All right, now here I think, okay, here also we forgot to change. We will change it to 30 minutes. Okay, so let me check if it's visible on the 4 hourly time frame. To some extent, okay, we got the values here. Now as you can see, what we are doing, we want the consolidation to have happened, and we will define a certain value just little above the minima of last 12 hours using calculation expressions. We will get that using ATR also. So maybe 10, 15 or 20% of the ATR range, and it should be above that from the minimum value. So that will mean that it is rising, and we are not exactly buying at the lowest price, and we will try to see that's the case. So here our EMA envelope condition will be fulfilled, and our Williams R condition is also going to be fulfilled. And now further condition will be of the minima, so we will define the entry point using these minima levels. Let me go back to the half hourly time frame, and suppose if the trade is going to happen somewhere here, we will add certain values to the minimal level. We will get a range. Suppose if we are adding 10 pips or 20 pips, now the value is of 107.79, and if we were to add 20 pips, then the buy trade should happen whenever it will start to rise above 108. And to make sure it is going to buy while the prices are rising, we are bringing in one more condition using the min max levels of 5 minutes for 12 candle periods. So it will be last 1 hour values, and we will be comparing the current value to the value 15 minutes back, and if and only if the values are equal to or rising, we will be executing the trade. So that will make sure that we are buying when the price momentum is strong and it is starting to rise. So this will help us optimize the entry and exit, and to make sure that we are well aware of the underlying volatility of any instrument which we are going to use. We will not go with a static target and the target stop loss. We will keep it dynamic using the ATR. So we will define certain range, maybe of 50-60% of the ATR, and we will keep the target and the stop loss dynamic depending on the instrument's volatility levels. So that will help us better. So now go back, it's time to go back to the Visual J Forex platform and start to build our algorithm. So let's go. What we have done so far, we have done this standard instrument subscription. This time around we are using USD JPY for most of the earlier algorithms. We were working with the Euro USD, and for a change I thought, okay, let's try USD JPY. Any instrument you can use for all the currencies. The platform is supported only for equity indices and commodities. You will have some trouble generating the source code, and for that you have to define the algorithm while keeping only the currency instrument. The parameters should be defined as per the CFD instrument you are going to use, and then export the file to the Visual J platform, and from there on you can choose that particular CFD instrument and then run it. It will do fine, but here you have to keep the currency parameter only. Then the position amount, all positions pending and open, it should be equal to 0. Then we got the EMA envelope candles to make sure that we are trading with the trend. The Williams R conditions here to define the overbought and oversold conditions. Then, as I explained to you on the charts, we are bringing in this min-max condition to make sure that we are trading with the optimum levels in mind, and we do consolidation also. So if there is a certain big move after making recent high or low, it shouldn't trade. So we are making sure by bringing in this min-max condition and also the calculation expression to get the desired levels. Then to look for the recent price action to guard against the undue volatility. We are bringing in these hourly min max values. So this is both for ask and the bid side. And I think we should also do one more thing. On the half hourly chart also we will need to take some shift values also. What we want to do, if suppose a new minima has been made in last hour or two, we don't want the trading to happen. Maybe trading can happen, but after some amount of time. And to make sure that's the case, we can try to bring in certain conditions, like making sure that at least 1 or 2 hours of price stability should be there. So suppose for a buy trade, what we can do, we will define that the current minima value of last 12 hours should be equal to or greater than the minimum value 2 hours back, not 12 hours back, 2 hours back of last 12 hours. So we will check the current minimum value with the minimum value 2 hours back of 12-hour time frame. And suppose if here, if a new low was being made, and certainly the current minima would have been less than the 2 hours minima. If that happens, then for next 2 hours no trade will happen, and as soon as 2 hours pass and no new low is made, then the trading can begin. So that is the purpose. If there is sudden shift in the momentum, we shouldn't be getting caught on the wrong foot. So that's the idea behind this condition being added. So we will need to bring in the values of the minima and the maxima of last 12 hours. So again we take the mathematical indicators. Here is the min max. We need two blocks of min max, one the ask of high price, one for the bid of the low price. And let me check the prior. Okay, we have got it right. Yes, this one is a bid of the low price, this is the high price on the ask side. Now we connect this. We define it for half an hour. We take we want 2 hours back value, so we will need to take shift 4. Yes, let me just check once again. Suppose if this is the current value, shift 1, shift 2, shift 3 and shift 4. So we will get the minimum value of last 12 hours, 2 hours back. The minimum value is of last 12 hours, but at the point in time when it was means 2 hours prior to the current time. So we take shift 4. Here also we will need shift 4. Okay, and now here we take 24. 24 multiplied by half an hour will give us 12 hours values. So that's the case, 24. Here also again 24, and then we change, we want the lowest price on the bid side, so we take the low price. We want the highest price on the ask side, so we take the ask side, and we will use this. Now we need to bring in the ATR, and then we will also need to define the entry and the exit points. So we will need to bring in the calculation expressions as well. I think we will need to get it a bit lower. We have to take care of the aesthetics as well, and whatever we do should look good, should feel good, and of course it should work good. Now let us bring the ATR. ATR, as we have been using for many sessions now, we take the daily values. So this is the ATR. We keep the default for time period, and we take this 24, day, 24 hours. We take shift 1, yesterday's value, and those who have been regular in the webinars, they might know why we do that. Still, I would again like to reiterate, we want the volatility defined till yesterday, as when the new day starts there is not much of a price action for that day, so because of that the value kind of goes down, and then after some hours pass again the ATR value starts to rise, and to guard against this we simply take the yesterday's value of the ATR. So that's the reason. Now our mathematical part begins, the optimization part. So we take the components mathematical, and a lot of calculations will need to be done to make sure that we are entering and exiting the trades at the right time, at the right price. So now again let us go back on the chart. So what you feel should be the optimum level from the current minimum value can be defined as a entry point, and for that we will need to bring two historical candles of 10 seconds or 1 minute, whatever suits your purpose. I basically prefer 10 seconds candle. We get multiple iterations for that. So it can be 10% of the ATR value, it can be 20% of the ATR value, or the 15% or 50% also. So see here, what we are going to do, I am not giving a exact recommendation that you should have or you should need to follow only my setup. We are simply developing, we are working with the ideas. So for this session I am going to use 20% range of the ATR. So whatever is the ATR, we will take the 20% of that, we will add to the minimum value, and when the price will start to rise above the level, suppose the ATR is of 100 pips, or yes, let's assume that the ATR is of 100 pips, then the value is 107.79, and then we will take the 20% of the 100 pips, that is 20 pips, we will add the 20 pips, and only when the value will current price actions value will start to rise above that level, the trade will execute, and it is going to be market open. We are not taking in pending open for this particular algorithm. So we define the value here, 20% of the ATR on candle. We need to define a new variable, create new variable double, and it should be entry point optimization EPO, or let's keep it EP, and then we will name the final as 0.2. Okay, 0.2. If we multiply the ATR by 0.2, it will get us the 20% of the ATR range. And now we bring this EP here, and we multiply A1 into A2, and we get the EPO. Okay, now we need to take the historical candles. So I hope you got the point that for the sell trade we will be subtracting the 20% of the ATR from the maxima. For a buy trade we will be adding the 20% of the ATR to the minima, and then we will watch out for those levels using the historical candles of the 10 seconds. So we need the info candle, guest historical candle, shift 1 and shift 2, last candle and the candle prior to that. So here we are. And again, let us define it. Default candle period at 10 seconds. Bit side, it's fine. Shift 0, we make it shift 1, and this will be shift 2, and it will be 10 seconds also. So this is the bit side, both are on the bit side. And now we are almost getting done with our initial requirements, but as we are approaching the end of our webinar session, I would say that we will continue to working on this on tomorrow's session. So here for the day we will wrap up the session, and then tomorrow we will start working on the buy side and then the sell side, and hopefully in couple of sessions time our webinar will be up, our algorithm will be up and running, and hopefully it will be profitable. So on that note, I would like to sign off for the day. See you tomorrow. Have an excellent day ahead. Goodbye.